everybody, Domenic here. And today we have the great Theo, mate. We've been talking for a few years now.
Yeah, it's been great.
And thanks for coming back on the show.
No worries.
You're busy as ever, winning awards and growing the team. You've come in here with resumes and stuff, so you never stop. Mate, talk to me a little bit. What's going on at the tail end of last year? How's finance and the world of banking and all that kind of stuff?
So the first 6 months of last year was a bit tough. The election slowed things down. We were still sort of recovering out of a bad market from the previous year. But then once the election was out of the way, once the RBA started cutting the cash rate, and also APRA loosening lending, the second 6 months was great. The tail end of last year, loads of buyers came back into the market. Confidence was back out. It was like a hot market again. Although a lot of people left, taking the initiative or taking action a bit too late. So some sellers trying to take advantage of the market, I think, didn't take enough initiative and call agents and get their property listed in time to get onto the market last year. So there wasn't that much stock on the market. So a lot of buyers were fighting over the low levels of stock. This year already we've seen the market start strong. There's been great levels of stock this year and starting early as well. Normally we don't start seeing the properties come on the market till now, really, just after Australia Day. But we've already started seeing it sort of the last couple of weeks. Got a lot of confidence for this year.
Yeah.
I think this year is going to be a strong year, especially with another, potential 2 more rate cuts to come.
Talk to us a little bit about that, because they were predicting, and all the major banks, their economists were saying, yeah, we're going to be cutting rates in Feb or whatever, but what are your thoughts?
Well, I just I looked up some interesting sort of stats and data on this recently for a blog post that we were doing, and it was only a bit over 10 years ago was the GFC, and in the GFC our cash rate was 7.25%.
It's not a bad return on your cash.
And then only about 9 years ago in 2011, 4.75% was the cash rate, and now we're at 75 points, 0.75%. That is a huge drop.
How much further can you go from 0.75,
Well, we were expecting another 2 more cuts, one next week, next Tuesday, and potentially one in March, but that's been pushed back. They're now talking, Bill Evans from Westpac, actually only literally 45 minutes ago, announced that they're predicting a cut in April and another cut in August.
Okay, so they're going to push it down the road.
Yeah, still 0.25% is going to be the end result. There's nothing left to go. One more cut, you're at zero.
And they've said they don't want to go to zero because practically there's no...
Well, look, now we're going into a real sort of economic discussion. But yeah, look, they're not going to go to zero. We're not going to see negative interest rates here, I don't think. Even if it went to zero, even if rates, the RBA went in a sort of as a negative rate, I don't think consumers will ever see what we see in other markets where,
Japan.
Yeah, no, I don't think that's going to happen here because of the margin between the banks and the actual borrowers. We are also already seeing the effects of rate cuts, as in it's working. Well, yes and no. It's funny. The fundamentals of economics hasn't really applied, in the last few years, as in what should happen from, things react.
Pull this lever and that should happen.
Exactly.
Yeah?
You pull this lever and normally that would happen. That's not happening, you know. Although, rates being so low has led to, share markets globally hitting all-time highs. We see the Dow Jones almost at 30,000. I think it cracked 29,000 recently. ASX just passed 7,000 recently, which is, actually just over where we were pre-GFC 12 years ago. So we've only just recovered to where we were 12 years ago, which isn't that good. But the Dow Jones, the US, has almost tripled. So they're booming over there. So if we do see another global financial crisis, which some say might be on the cards, I think it's going to affect America more than it would affect us. Just because we haven't, pumped up our stock market on debt like they have. And I think property here is still always a safe haven. Yields on property has also decreased. So when rates go down, share markets rally and yields decrease across the board in all asset classes. So that includes shares. So that across the ASX, what you get on a blue chip company in terms of a dividend yield is quite low at the moment, and no different for investors on investment properties. Years ago you could have picked up 4 or 5% return on an investment property. It's a bit harder to find that now. Investors are probably having to come to terms with taking 2-3% home gross.
Yeah, and you can see that even in the property market that there's just way more investment properties out there. It's harder to lease your traditional property out, and the rents have come back a little bit. So everything you've just discussed is absolutely true, and you're seeing it in a real practical way in the property cycle. But let me ask you, so we walking into the next couple of months, and we can see that there may be some other rate declines or decreases. What are the practical realities of that? Like, can we see banks decrease rates even further? Do you anticipate much change in the banking environment for me as a home buyer or an investor?
That's actually a really good question, right? How much of a difference does it actually make to the person borrowing money? From a serviceability point of view and a borrowing, power point of view, as in, how much will it mean I could borrow a lot more? No, not necessarily, because, APRA did make some changes mid last year to increase your borrowing capacity, or everyone's borrowing capacity, but they did put some floors and caps on that, so that, there is a minimum still assessment rate. The banks in the last few rate cuts, haven't been passing on that much either. So, if there's another couple to come, I imagine they're probably only going to pass on 10, 15 points at most out of the full 25-point cuts. So, yeah, and what does that mean on a, let's say a $700,000 mortgage? Not an awful deal, not an awful amount. So I just think it gives people a bit more confidence to go out there and buy, knowing that the rates are low. They could buy a property and it pretty much could be positively geared from day one if they've got a decent deposit. Even if you don't have a decent deposit, what you're paying, I think we did a report on this recently, what you're paying for a typical 2-bedroom property in metropolitan areas around Sydney and Melbourne and whatnot, what you're paying to rent a 2-bedroom apartment is probably equivalent to what you'd pay in interest to borrow 80-90% to own it. So yeah, look, on that basis, I just see that the property market will stay strong.
Yeah, so you do see a surge in the property market.
I think this year we've got 5 to 10% in us in terms of growth in good areas, right? In good areas where
not oversupply.
Yeah, not a supply issue. There's a consistent demand. There's not some something that's changing the whole main road or something like that in a bad way. The biggest problem with Sydney in particular is supply. It's not like some other areas where they're building thousands of units in one area. They can't physically sort of supply Sydney with enough housing. There's a housing shortage, and demand's only increasing. I think we spoke about this last year in a different podcast of ours, that in the last few years, the supply of housing has eased because the banks tightened up funding to developers, but the demand for housing increased. So surely that's going to play catch up.
Well, I sat down with one of the chief economists or head economists at HIA. That's the Housing Industry Association. Now, they work very, very closely with the building industry and talk and comment to the housing supply. They pay very close attention to where the DAs are, so development applications. And they reported at tail end of last year that supply came off 40%, something more than that. And then the delay for that to then come into the market is if the supply or if the DAs coming through council were to increase by 50% or 100%, there's still a 2 to 3 year delay.
Lag. Yeah, it's a really good point. The lag of addressing the issue it takes years, because let's say the banks all of a sudden say, all right, we will be more accommodating to developers now, and we'll support, developers trying to build a couple hundred unit residential development sites. Once that gets announced, then people start working on opportunities. Maybe they rezone areas. Also, that takes a while for people to start working on opportunities. And then once they do work on an opportunity, then they go to market. It's still 2 years before completion. It takes a while for these things to happen. So, yeah, I think that lag just means demand on what's on the market at the moment, and what's on the market is limited.
So, mate, that's a great commentary on it. Thank you.
Yeah.
So, what opportunities are you seeing out there? I think that I'm catching some that one, if you are a renter out there, then it is an opportunistic time for you to stop renting and buy and rent and live in your own home. Sorry, buy and rent in your own home. I keep on saying rent. Or there is also an opportunity for you to go out and start accumulating additional investment properties because, the interest rate is so low at the moment.
Mm-hmm.
Are there any particular areas or are there any particular sort of opportunities or parts of the market that you think are interesting? Because you talk to so many people and you have so many clients, but just, is there anything that you've caught onto?
Well, look, I think what you just said there, two different scenarios, someone renting, looking to buy, or someone owns, thinking about buying another one. Both those people don't think typically that it is possible for them to do either of the two, right? They don't know. And it always starts with a conversation. I know, and I've been doing home loans for 10 years, and the amount of people that I just casually are having a chat with at the pub or something, or at a coffee shop, not because I'm trying to sell them a home loan, but
it's what you do for a living.
But just because what I do for a living, and the conversation arises of potentially buying, and they didn't think it'd be possible, and then after they join a couple dots and realize they could make it work, all of a sudden the momentum just takes off. They think, okay, this is possible. I can actually afford to buy a property. And for the second scenario you mentioned, where it might be someone who already owns one trying to buy a second, they realize I might not even have to tip in any sort of ongoing cost, a monthly repayment. I actually could potentially earn $50 a week from it or something like that. So, yeah, look, I think to have a conversation, see if it's achievable for you. For first home buyers, people trying to buy their first one, you don't need a big deposit. You can get away with 5% these days. You can also use a guarantor to help you get the property, the loan approval. Guarantors meaning that you don't need any deposit whatsoever, and a family member can use their property as additional security. Mm-hmm. There's limited guarantees there as well. So it's quite achievable in anyone's situation.
Do you? Because I remember back in the good old days, we could almost get 100% loans, or we could get 100% loans. At the moment, it's difficult to go and get your 10 to 20% deposits, or 90 to 80% LVRs. Do you think you're going to see some more of those highly geared?
It's still possible to do 90-95% loans. And it got harder in terms of they got a bit more due diligent in checking the client situation, like looking at bank statements and looking at credit card statements and actually verifying people's living expenses and actually checking what they're declaring is true. But still, the policies were there. It was still doable. I personally would recommend not going above 90%, purely because mortgage insurance becomes quite high above 90%.
Okay.
Although there are incentives now with the government and for first home buyers to have mortgage insurance waived. There also are a lot of people don't know what's available to them. There's a lot of waivers of mortgage insurance even to consumers. Bank of Queensland is offering mortgage insurance waivers to people in certain professions. We've got relationships with all the major banks that allow us to give doctors, engineers, accountants and solicitors, an exemption to mortgage insurance. So if you qualify for one of them, I wouldn't see any hesitation of borrowing 90%. But yeah, to answer your question, look, it's probably gone. It got harder to borrow money above 80% up until about June last year. Got harder for about 2 years, and then once APRA made those changes, we're slowly seeing a bit more of an appetite from all the banks to entertain that space, because we had the correction, because things have slowed down, and because I think there's a bit more confidence back in the marketplace.
So it really sounds like what I'm taking from you here is, if you're on the fence, if you're unaware and you're tossing around different ideas in your head, it all starts with a conversation. Sit down with a consultant, a mortgage broker, with a property consultant, someone that is technically sophisticated in finance or in wealth-related strategies, because there's a lot that they know that you don't know. There's a lot that you may not be aware of, or you're too close to your personal circumstance, so they can say, listen, have you thought about it this way?
Exactly right.
Okay, so just some parting thoughts. Mate, where can people find you? If people want to hear more about you and from Theo and from Shore Financial, I know that you got the podcast, and you've also got the you put up different media articles and things. Is there anything happening in your world in Shore?
Yeah, look, visit our website, shorefinancial.com, and that's Shore as in SHORE. We've got blog posts and we're constantly releasing interesting content. We focus on making sure our content is informative, as our newsletters are as well. Our brokers are also brokers that specialise in being a bit more advice driven. You know, they're relationship sort of managers. 90% of them are tertiary educated with some sort of degree. We've got several of them that are previously chartered accountants, previously by trade. So they're very qualified people that will give you good advice. They'll even, for example, the ones that were chartered accountants previously by trade, they'll probably make some suggestions for you to go start a conversation with your accountant on maybe how to structure something as well. To your point, exactly right. It's all about advice. But, with advice, it starts with you going out there and seeking it, definitely for your accountant. Your accountant's typically very reactive versus proactive.
You need to go and ask the right questions.
Yeah, you need to go out there and ask the right questions. Exactly right. But yeah, look, anyone wants any more information, visit our website. We'll be more than happy to put you in touch with any of our staff.
Theo, thank you very much for coming on the show today. Very insightful as per usual. Mate, look forward to having you again soon.
Thank you.